There is a specific type of theft that is perfectly legal. It happens on blockchain networks every single day. It has been happening on Flare since the day it launched, and the people doing it are not hackers, not bad actors, not exploiting a vulnerability. They are bots. Every time a transaction executes on a blockchain network, there is a window measured in milliseconds where the order of transactions can be arranged to extract value from users before their trade settles. This is called MEV, maximal extractable value. And on most networks, that value flows entirely to private actors, bots, validators, sophisticated market participants who capture it and walk away. The network generates the activity, the users pay the fees, but the economic value created by that activity never returns to the protocol. It leaks out. Every transaction, every block, every day. On Flare, that leakage has been happening for years. This week, a governance vote closes that ends it. And 96.8% of voters have already said yes. Welcome back to XRP News Flow Signals, where we cover the full digital asset ecosystem, not just price action. This is not financial advice. Always do your own research. But if you hold Flare, are considering it, or hold XRP and want to understand what Flare's tokenomics overhaul means for the broader ecosystem, this breakdown maps it precisely. Let's get into it. Let's start with the hard truth that most Flare coverage never stakes directly. For years, Flare has been generating real on-chain activity. Data requests through the Flare data connector, FXRP bridging and cross-chain flows, smart account execution, confidential compute, transactions of real economic value happening on a network that was specifically designed to bring XRP and other assets into a programmable, data-connected environment. But here is the structural problem that FIP16 is designed to solve. Most of that value never came back to the network. It was captured by bots through MEV extraction. It leaked through assertion fees that went to third parties. It dissipated through an inflationary reward model that paid for participation with new token issuance, rather than recycling the economic value the network was actually generating. The result? Flare had real activity, real usage, real utility, but the token's value was continuously diluted by 5% annual inflation, while the economic value of that activity drained out through channels that benefited everyone except FLR holders. FIP16, the governance proposal now in active voting through April 24th, is a complete architectural response to that problem. The proposal creates FIRE, the Flare income-resistant entity. It is not a marketing concept. It is a protocol-level revenue routing mechanism that sits on top of all fee-generating activity on the Flare network and directs that value with a specific mandate. Reduce FLR supply through open market buybacks and burns. Here is what gets routed into FIRE under the proposal. FDC data connector assertion fees, jumping from 1 FLR to 20 FLR per assertion, with 90% flowing into FIRE. FXRP bridging and cross-chain flow fees. Flare smart account execution fees, confidential compute fees, and critically, MEV capture at the protocol level through protocol-owned block building that intercepts the value that has previously leaked to private bots. Every one of these revenue streams currently either escapes the protocol entirely or is recycled as inflationary rewards that dilute existing holders. Under FIP16, they all route into FIRE. And FIRE's primary mandate, not secondary, not optional, primary, is to burn FLR. The network stops leaking, the value stays inside, and the burn begins. Now let's run the numbers, because this is where FIP16 stops being a governance proposal and starts being a supply mechanics argument. Start with inflation. Current Flare annual inflation, 5%, meaning 5 billion new FLR tokens are issued each year into a market where holders are simultaneously trying to accumulate. Every new token issued is dilution. Every dilution is a headwind against price appreciation, regardless of demand. FIP16 cuts that to 3%, reducing new issuance from 5 billion to 3 billion tokens per year. That is a 40% reduction in the annual dilution rate. On its own, that changes the supply math significantly. But the inflation cut is not the primary mechanism. The burn is. Current annual FLR burn from base gas fees at 60 GWE, approximately 7.5 million tokens per year. FIP16 raises the base gas fee to 1,200 GWE, a 20x increase. At current network activity levels, that change alone projects annual burns to approximately 300 million FLR per year. A 20x increase in the base gas fee converts a 7.5 million token annual burn into a 300 million token burn at current activity levels before any growth in network usage. If Flare's on-chain activity grows 100% from current levels, the burn approaches 600 million tokens annually. At 200% growth, closer to 900 million. At sustained ecosystem expansion, which the Fire flywheel is specifically designed to accelerate, annual burns exceeding 1 billion FLR become mathematically achievable. Now combine the two mechanisms. 3% inflation cap, 3 billion new tokens per year. 300M plus annual burn at current activity, effectively minus 300M from the new issuance. Net inflation at current activity levels drops to approximately 2.66%. And every incremental transaction from this point forward widens the burn and narrows that gap further. The path from 5% gross inflation to net zero or net deflationary is now a function of network growth, not a distant aspiration. The vote is passing. The implementation timeline is weeks. Now layer on the data connector fee change specifically, because this is the signal that most analysis is underweighting. Flare data connector assertion fees rising from 1 FLR to 20 FLR per assertion means every piece of external data brought on-chain, every price feed, every cross-chain signal, every Oracle assertion now generates 20 times the protocol revenue it did before. With 90% of that flowing into Fire for buybacks and burns, the data utility that Flare was specifically built to provide becomes a direct supply reduction mechanism. The more the network is used for its core purpose, trustless data, the faster FLR supply contracts. That is not a prediction. That is the mechanical output of the fee structure being voted on right now. Now let's talk about the vote itself, because the participation data tells a specific story about where the Flare community's conviction sits. As of the time of this analysis, 96.8% of votes cast are in favor of FIP16. The proposal requires only a 50% majority to pass. The gap between the threshold required and the support being demonstrated is not close. It is categorical. But here is the detail that matters more than the percentage. The voting period runs from April 17th to April 24th. That means we are inside the active window right now. And the precedent set by FIP01, the previous major Flare governance proposal, shows that once a vote passes, live implementation follows within weeks, not months. That is not a long timeline. For holders who have been waiting for a structural catalyst that changes Flare's tokenomics from inflationary to deflationary, the implementation clock is already running. Now let's talk about the flywheel mechanism, because this is the architectural argument that separates FIP16 from typical crypto governance proposals. Most blockchain tokenomics changes are linear. Cut inflation, price goes up. Add a burn mechanism, supply decreases. The relationship between the change and the outcome is direct and relatively simple. Fire creates a compounding loop. Network activity generates protocol revenue. Fire captures that revenue. Fire deploys it into buybacks and burns, reducing supply. Reduced supply with stable or growing demand produces upward price pressure. Higher FLR prices make the network more attractive to validators, stakers, and ecosystem builders. More ecosystem participation generates more network activity. More activity generates more protocol revenue. More protocol revenue into Fire produces more buybacks and burns. The loop compounds. Each rotation amplifies the next. Flare's CEO Hugo described the core logic precisely. Fire has a dual mandate: reduce supply and develop the ecosystem, because developing the ecosystem ultimately removes more supply than pure burns alone would achieve. The growth investment and the supply reduction are the same mechanism viewed at different timescales. At the current $175 million TVL, this flywheel is already primed. What FIP16 does is connect the engine to the fuel that has been generating, but previously losing since the network launched. I want to pause here, because mapping the MEV leakage problem to the Fire architecture, to the burn math, to the flywheel compound loop is the kind of tokenomics forensics that requires reading the actual proposal, not just the headline. If you want this level of structural analysis on Flare, on XRP, on every major development in the digital asset ecosystem, subscribe to XRP News Flow Signals right now and turn on notifications, because the implementation timeline after April 24th is going to produce specific, datable supply events, and you want the analytical framework already in place when they land. Let's be precise about what the next 6 weeks look like if FIP16 passes, because the implementation sequence matters as much as the proposal itself. Phase 1. Vote closes April 24th at 96.8% support against a 50% threshold, barring a catastrophic reversal in the final week of voting. FIP16 passes. The Flare Foundation and validators receive authorization to begin protocol parameter updates. Phase 2. Network governance action, weeks 1 to 2 post-vote. Based on the FIP01 precedent, parameter updates and network governance actions begin within weeks of vote confirmation. The base gas fee adjustment from 60 GWE to 1200 GWE is the first mechanical change. The moment it activates, the burn rate jumps from 7.5 million to 300 million SLR, projected annually. Phase 3. Fire revenue routing activation. As FDC assertion fees move from 1 FLR to 20 FLR and the 90% Fire routing activates, the first protocol revenue begins accumulating in the buyback and burn pool. The first open market buyback operations become possible once sufficient revenue has accumulated. Phase 4. MEV capture infrastructure. Protocol-owned block building for MEV capture is described as a roadmap item, meaning it follows initial implementation on a separate timeline. But once active, it closes the final significant value leakage channel that has been extracting from the network since launch. The key date? April 24th. Everything else in this timeline is downstream of that vote, and the vote is already passing by a margin that leaves little room for reversal. Here is the supply picture that the FIP16 math produces. Current annual FLR burn, 7.5 million tokens. Post-FIP16 projected burn at current activity, 300 million tokens. At 2x current activity, 600 million tokens. At 3x current activity, approaching 1 billion tokens. Against a reduced inflation cap of 3 billion new tokens per year, net inflation compresses with every increment of network growth. The network has been generating the activity that powers this math since launch. The value was leaking out through MEV extraction and fee drainage. After April 24th, it stops leaking. The same activity that previously enriched bots begins reducing supply for holders. The engine does not change. The destination of the value it generates does. Let me leave you with the frame that makes all of this land correctly. Flare has not been failing. It has been generating real economic activity, data requests, bridge flows, smart account execution, compute fees, and losing the value of that activity through structural leakage that FIP16 is specifically designed to close. The bots took the MEV. The third parties took the assertion fees. The inflationary model diluted the holders who stayed. FIP16 captures the MEV, routes the assertion fees into fire, cuts the inflation, and creates a compounding flywheel where every incremental transaction narrows the gap between gross issuance and net supply reduction. 96.8% of voters understand this. The vote closes April 24th. Implementation follows within weeks. The burn math changes the day the gas fee parameter updates. The value leakage ends. Not someday, this month. If this breakdown mapped FIP16 in a way that the headlines didn't, subscribe to XRP News Flow Signals before the April 24th vote closes. We will be tracking every implementation milestone, every fire revenue event, and every supply data point as the burn math becomes visible on-chain. Drop one word below, fire, if the flywheel architecture landed for you. Let's see who caught the structural signal. Stay sharp. The signal does not lie. Not financial advice.